Commercial banks are considered depository banks, which means they take deposits from the public and then they lend this money to the public as well. Therefore, when we talk about the balance sheet, we know that this is our magic box, which is assets financed through liabilities and equity. When we talk about a balance sheet for a bank, so this is a bank balance sheet, assets here refers to loans. So anytime a bank gives a loan, it's considered an asset from the commercial bank perspective. And then anytime a household or a business, they put any deposit here, this is considered a liability. Therefore, from the bank perspective, assets mainly refers to loans and liabilities mainly refers to deposits. So we had tough regulation in the banking sector until 1980s. So 1980s, before we had tough regulation. And then after, we started to have a process of loose regulation, which we call it deregulation. So the main problem of the tough regulation is it resulted in a lower market share for banks and a higher market share for non-bank financial institutions. Therefore, banks started to put pressures in order to have less regulation. Consequently, after 1980s, banks started to get a higher market share and non-bank financial institutions started to get a lower market share. Therefore, before 1980s, during the tough regulation phase for banks, banks used a strategy which is called asset management. We said for any bank, assets refers to what? Assets refers to loans. This means that a bank will give loans based on available deposits. This means that if the bank has a certain number of deposits and then he gives a loans based on these deposits, he's not going to give extra loans because these loans are mainly based on, are tailored to the available deposits. Then after deregulation, after 1980s, the bank changed the strategy to be liability management. And we know that liability refers to what? Deposits. Therefore, the bank will use deposits plus other funding in order to meet the loan demand. Which means anytime there is higher demand for loans, what will happen is the banks will use its own deposits. If the deposits are not enough, the bank will start to search for extra funding. So this extra funding could be mainly through borrowing. And when we talk about borrowing, we refer mainly to the capital market. Which means they will go to the capital market and they will sell securities. And this capital market could be either domestic or international. Or another way of funding is they will provide some financial service. Consequently, they will get extra capital to meet this higher demand for loans. Or the third option for funding will be off-balance sheet financing. We will explain off-balance sheet financing later on in more details.